Imagine spending, I don't know, like $10 million rolling out this state-of-the-art global ERP system, right?
Which happens all the time.
Exactly. And your CFO in New York, they absolutely love it.
Mhm.
Your operations team in London is just thrilled with the real-time analytics.
Everyone is happy.
Everyone is happy. But then your local tax auditor in Warsaw walks into the office, looks at your pristine, auto-translated English ledger, and just, well, they tell you the entire system is legally invalid.
Yeah, that is a very expensive day at the office.
A massively expensive day. So today we are unpacking exactly why that happens and, more importantly, how to prevent it. We are taking you on a deep dive into the incredibly specific, highly technical world of structuring a Polish chart of accounts for ERP systems.
Right, because it's a completely different landscape.
It really is. And we're pulling all of this from a very detailed internal technical roadmap, which is simply titled Polish Translations-Localization.pdf. So our mission today is really to bridge that massive gap between global software architecture and Poland's, quite frankly, uncompromising statutory reality.
Okay. Let's unpack this.
It's a gap that honestly swallows international software deployments whole. I mean, what works intuitively in a unified Anglo-American accounting environment, it just does not simply map over to Central Europe.
Right.
We are talking about a landscape where the language, the database schemas, even the foundational logic of double-entry bookkeeping, they are all deeply, deeply tied to local law.
Well, I want to start right with the detail that completely upended my understanding of how international business software works.
Okay, lay it on me.
When I look at global commerce, English is kind of the default operating system, right? But in Poland, it is currently the only country where the Polish language is the official, legally mandated language for professional accounting.
Like, it's not a preference, it's an actual law. Setting up an ERP in Poland without understanding the little rules is, well, it's like trying to navigate the Warsaw subway using a map of the London Underground.
That's a great analogy.
You might understand the concept of a train, but you are going to end up in the wrong place entirely.
Exactly. And it is an uncompromising legal standard. It's rooted in the Polish Accounting Act of 1994.
Okay, the 1994 Act.
Ustawa o rachunkowości. It dictates that all accounting records, all supporting documentation, and all financial reports, they absolutely must be maintained in Polish.
Wow. All of it.
All of it.
Yeah.
And ledgers must be kept in the national currency, the Polish zloty.
Right, PLN.
So if you are deploying software to a Polish subsidiary, the application must be capable of producing reports, ledger printouts, tax files, all with headings and descriptions entirely in Polish.
See, I would have assumed that given Poland's integration into the global economy and the fact that Polish is spoken as a recognized minority language in neighboring countries like Lithuania or the Czech Republic, Slovakia, Ukraine,
Sure.
there would be some cross-border flexibility there.
Yeah, you're hitting on a really fascinating jurisdictional boundary there.
Am I?
Yeah, because in those neighboring countries, even if a business is run entirely by Polish speakers, the statutory filings must be in the primary national language of that jurisdiction.
Ah, okay. So Lithuanian in Lithuania.
Exactly.
Mm-hmm.
Poland is entirely unique in enforcing this strict professional accounting monopoly for its own language within its borders.
Well, but let me push back on that for a second, maybe from the perspective of an EU integration specialist.
Go for it.
Poland is a massive pillar of the European Union economy, right? And EU law typically supersedes domestic law in a lot of commercial areas.
True.
Doesn't the EU framework force Poland to accept broader European standards, like maybe English ledgers, just to facilitate the single market?
Well, the EU framework adds translation layers at the macro level, but it fundamentally respects domestic statutory mandates.
Oh, really?
Yeah, I mean, Polish is one of the 24 official EU languages, so EU-level directives and financial regulations, those are translated into Polish.
Right, okay.
However, the actual statutory filings, the granular XML files, the balance sheets, the ledger extracts submitted to the Polish Ministry of Finance.
The nuts and bolts.
Exactly, the nuts and bolts. Those remain strictly domestic affairs. The EU does not dictate the operational language of a domestic tax audit.
Okay, so wait. If I am the database administrator for a massive multinational, let's just call them global tech, right?
That's global tech.
And I have a centralized Oracle or SAP instance running my global operations. My master ledger is in English. My CFO demands global visibility.
Yeah.
Are you telling me I have to build an entirely parallel universe of Polish descriptions just to satisfy local auditors?
Yes. That is the exact operational hurdle that catches foreign implementations entirely off guard.
You're kidding.
Nope. You cannot simply hand an English ledger printout to a Polish tax inspector. It just won't work.
So what happens if I do?
If you do, you are legally required to provide certified Polish translations of every single accounting entry and report requested during that audit.
Wait. Certified translations.
Yes.
You mean hiring, like, a sworn translator, a tumas presidigu, to sit there and manually translate thousands of lines of an Oracle database export?
That is exactly what I mean.
But that would cost an absolute fortune. Not to mention, it would grind operations to a complete halt.
It paralyzes the business completely. And this is precisely why building multi-language ledger descriptions natively into the ERP's architecture is critical from day one.
Oh, I see.
I mean, you can absolutely use English or another language for internal management reporting back to the parent company.
Right, the CFO can still get their English reports.
Exactly.
Right.
But the underlying foundational entries, the base data layer in the Polish subsidiary system, it must be structured and described using Polish accounting terminology.
That is wild.
Yeah. The business reality of a transaction, say buying servers from Germany with an English invoice, the transaction itself can be international, but the statutory recording of that invoice is strictly local.
Okay, so when you look at the bedrock of these requirements, it seems like all roads lead back to that 1994 Polish Accounting Act.
They do.
But it's not the only rule book, right? We have to know how global accounting standards interact with these local laws.
Because translating words is just a UI problem. Translating financial concepts, that's an architectural problem.
Exactly. So let's talk about the hierarchy of these rules. The PAA, KSR, IFRS.
Right. So let's break down the hierarchy. The PAA, the Polish Accounting Act, that is the Constitution.
The Constitution, okay.
It provides the overarching rules for valuation, depreciation, the mandatory format of financial statements. It's heavily influenced by EU directives, and professionals locally often just refer to it as Polish GAAP.
Got it. Now, the roadmap also dives into something called KSR. So if the PAA is the Constitution, how does KSR function?
So KSR stands for Krajowe Standardy Rachunkowości.
National Accounting Standards.
Exactly. The Polish Accounting Standards Committee issues these to fill in the operational gaps.
Oh, like the specific details.
Right. So if the PAA gives you the broad strokes, the KSR acts as the specific local traffic laws.
Traffic laws. I like that analogy.
Yeah, so if you need to know exactly how to value a really complex multi-year construction contract.
Which is always a mess.
Always.
Oh.
Or if you need to know how to classify a highly specific type of financial lease, the PAA might be too vague. The KSR provides that granular, step-by-step guidance that local accountants rely on daily.
Okay, so Constitution and traffic laws. But where does IFRS fit into this ecosystem? Because, any listener working for a publicly traded multinational is probably thinking right now, well, we use international financial reporting standards. We don't use Polish GAAP.
Right. And if we connect this to the bigger picture, IFRS, which is known locally as MSSF, by the way.
Wow, MSSF, okay.
Yeah, that is the international maritime law in this analogy. If a company is traded on the Warsaw Stock Exchange, EU regulations make IFRS absolutely mandatory for their consolidated group financial statements.
Oh, mandatory for listed companies.
Yes.
But what if I'm not listed? What if I'm just that Polish subsidiary of Global Tech we talked about?
Okay.
Can Global Tech force me to use IFRS so my data smoothly rolls up into their global SEC filings in the U.S.?
They can choose to have the subsidiary prepare its individual financial statements under IFRS.
Oh, they can?
They can. But, and here's the critical friction point, even if you adopt IFRS for your valuation principles, the ERP system recording those daily transactions must still generate the localized Polish tax files.
Ah, there's no escaping the taxman.
None. You still have to conform to the ledger structures expected by the local authorities. You basically don't get a free pass on local tax compliance just because your parent company uses IFRS.
Wow, so we have this complex web, right? The PAA Constitution, KSR traffic laws, and IFRS maritime law. Depending on what kind of vehicle your company is, you have to know which laws apply.
That's a perfect way to put it.
So how do we actually build a ledger that satisfies all of them? I mean, where do we start? The technical roadmap points to something called the Wasserkowy Planned Kont.
Yes, the standard chart of accounts.
Let's look at the foundational architecture here. Is this standard chart mandatory?
Well, interestingly, modern Poland doesn't have a legally rigid state-enforced chart of accounts that every single private business must use down to the last digit.
Oh, really?
Yeah, you actually have some theoretical flexibility there.
But I'm sensing a but.
A huge but. In practice, almost all medium and large companies adopt a standardized decimal system. It's classes 0 through 8.
So if the state doesn't force it, why does the market universally adopt it? Is it just, like, inertia?
It is entirely about systemic friction.
Friction, how so?
Think about it. If an auditor from the tax office walks in and sees a familiar decimal landscape, the audit proceeds smoothly.
Right.
But if you've completely reinvented the general ledger to match your U.S. headquarters, the auditor will spend weeks questioning every single mapping decision.
Oh man, that sounds like a nightmare.
It is. Furthermore, this standardized decimal structure is exactly what Polish universities teach.
Oh, so it's culturally ingrained in the profession.
Absolutely. If
Mhm.
your ERP aligns with this standard, local accountants can sit down and use it intuitively. If it doesn't, you face massive training costs and really high error rates.
Okay, that makes total sense. So let's briefly look at these classes for newcomers to the Polish system. Classes 0 through 3 seem pretty standard globally, right?
Yeah, very standard.
Class 0 is fixed assets, aktywa trwasz. Class 1 is cash and bank, środki pieniężne. Class 2 tracks receivables and payables.
Which the roadmap heavily emphasizes as rozrachunki. We will come back to that word.
Right, rozrachunki. I want to make sure everyone is comfortable with that term because it means settlements or accounts receivable and payable.
Exactly.
And then class 3 is inventory, materiae, i. The fundamental concepts are the same everywhere for those first few.
They are.
But where the Polish system completely breaks the mold, and from what I understand where international ERP architectures often completely fail, is what happens when money goes out.
Yes, the great divide.
Right, the great divide between class 4 and class 5 expenses. We really need to dissect this.
We do, because this is a profound structural difference. In a typical Anglo-American setup, expense tracking is straightforward, right?
Very.
You incur a cost, you debit a specific expense account, you buy lumber, you debit raw materials expense, you pay your staff, you debit payroll expense.
Right, a single debit, a single credit to cash or payables. Clean, simple, done.
The Polish system views expenses through a dual lens.
A dual lens.
Yeah. Companies can choose how to build their P&L, but most medium to large entities deploy what is known as the full set. They track expenses by their nature and simultaneously by their function.
Wait, tracking them simultaneously? I'm trying to map the journal entries in my head right now.
That's tricky.
If I record the exact same expense by its nature and its function, I'm debiting two different expense accounts. Doesn't that just double count every single cost and completely destroy the profit and loss statement?
It totally would if you didn't have a fulcrum to balance it. Let's look at the two sides first.
That's it. Walk me through it.
So, Class 4 tracks expenses by nature. This answers the purely objective question, what exactly was purchased?
So the item itself.
Yes. The accounts are rigid. 401 is for materials, 402 is for external services, 404 is for wages. It does not care if the wages went to a factory floor worker or the CEO. It is simply a wage.
Oh, I see. So class 4 is basically the grocery receipt. It just tells you that you bought eggs, flour, and sugar. It is raw, unallocated expenditure.
Yes, exactly. But a business cannot optimize its operations based solely on a grocery receipt.
Right. You need to know what you baked.
Management needs to know the cost of production versus the cost of administration. That requires Class 5, which tracks expenses by function.
Ah.
This answers the question, where did this expense occur and what project or department consumed it?
Sticking with the analogy then, class 5 is the meal prep.
I like it.
It tells you whether those eggs and flour went into the client birthday cake project, which generates revenue, or the internal staff breakfast project, which is just overhead.
Exactly.
So you might have account 501 for production costs and maybe account 550 for general administration.
Spot on. Now, to your earlier point about double counting.
Right, because my P&L is currently blowing up.
Right. The mechanism that prevents this is the most critical clearing account in all of Polish accounting. It's account 490.
Account 490.
What's fascinating here is that it acts as the great reconciler.
Okay, so it's the kitchen counter where the ingredients are transferred.
Exactly.
Walk me through the exact mechanism, though. How does account 490 actually function in the ERP's journal entry? Let's use a real example. Let's say we paid 10,000 PLN in wages to the factory workers.
Okay, perfect. Step 1. You record the objective nature of the expense. You debit account 404, wages, for 10,000 PLN, and you credit your payroll liability account.
Okay. Class 4 is populated. The grocery receipt shows we bought labor.
Step 2. You allocate that labor to its function. Because they're factory workers, you debit account 501, production costs, for 10,000 PLN.
And here is where my P&L shows 20,000 PLN in total expenses. Panic sets in.
Right. To neutralize that second debit, you simultaneously credit account 490, which is named Rozliczenie Kosto, or expense clearing. You credit it for 10,000 PLN.
Oh, I see the architecture now. Account 490 is a contra expense account.
Yes.
So if you take the sum of class 4 plus the sum of class 5 minus the balance of account 490, you arrive back at the true net expense of 10,000 PLN.
Exactly.
But by pushing the data through this matrix, you generate two completely independent reporting dimensions.
It acts as a mirror.
A mirror.
Yeah, on the class 4 side of the mirror, statutory auditors and tax authorities get exactly what they want. A clean, unmanipulated list of what the company spent money on.
Which they love.
They do. And on the class 5 side, the internal management and cost controllers get exactly what they want. A detailed breakdown of departmental efficiency and project profitability. Account 490 is the silvering on the glass that makes that reflection possible.
Wow. So if you are an ERP architect listening to this right now, and your software cannot handle automated real-time allocations through a contra account like 490, well, you are going to have a catastrophic implementation in Poland.
Complete failure.
You can't seriously ask accountants to manually calculate and post those 490 clearing entries for every single transaction, right?
No, the ERP must handle the class 4 to class 5 bridging natively. It is a rigid, non-negotiable requirement for robust localization.
Okay, so we've mapped the grand architecture of where expenses flow, but an ERP can't just operate at the 50,000-foot view of classes 4 and 5.
Right. You need details.
Exactly. When you actually owe a specific supplier money or a specific customer owes you money, you need deep granularity. How does the Polish system map individual entities, step by step?
Okay, so the single-digit classes we just talked about are the highest level of aggregation. Below that, the system uses a 3-digit structure for the main account.
The main account.
Yes, which is formally referred to as the synthetic account. So in Class 2, settlements, you have main account 201 for Rozrachunki Zdowcami, which translates to trade payables.
Okay.
And you have main account 202 for Rozrachunki Odbiorkami, which is trade receivables.
But I can't just have one giant receivable account, right? I need to track what, say, Jan Kowalski owes me versus what Global Tech owes me.
Right. And that is where the system expands into sub-accounts, known as analytical accounts.
Analytical accounts, got it.
You append digit to the synthetic root. So a specific customer, like Jan Kowalski, might be mapped as 202 Dan 0000 Lin. The next customer is 200000002, and so on.
Let me stop you there. If I'm a database developer integrating a global CRM into this Polish ERP,
Oh, I see where you're going.
yeah, my CRM already assigns a unique auto-generated ID to every customer. Say Jan Kowalski is customer ID 88392.
Right.
Why do I have to force his ledger account into this 202- format? Why can't his sub-ledger count just be 88392?
Because if you drop a flat list of random numerical IDs onto a Polish tax auditor's desk, they cannot parse your ledger.
They just won't accept it.
No, because the 201 and 202 prefixes are the implicit language of the audit. When an auditor looks for your trade receivables, they filter the database for the 202 group.
Oh, I see.
If your receivables are scattered across proprietary non-sequential global IDs, you are severely obstructing the audit process.
So it's mostly about legibility to the governing authority.
Legibility, yes, but it is also a strict legal mandate governed by a document called the Polityka Rachunkowości.
The accounting policy.
Exactly. And this isn't just an internal wiki page or a, suggested best practice guide. It is a formal, legally binding document. It's written in Polish, drafted by the chief accountant, and physically signed by the company's management board.
Signed by the board. Wow.
Yeah. It defines every main account and the specific logic for generating sub-accounts. If you decide to bypass the 202 prefix just because your CRM doesn't like it, you are operating outside of the board-approved legal framework.
Which is a huge red flag.
Massive. You would have to formally amend the company's legal policy just to accommodate bad software integration.
That is wild. Now, there is a highly specific warning in the roadmap regarding the database architecture needed for these analytical accounts. It mentions a database management tool called Flame Robin, and it specifically warns developers about SQL error Natus 303.
Yeah.
What is the underlying mechanism causing that failure? Because that sounds really technical.
This is where statutory localization crashes headfirst into bare metal database architecture.
Okay, break it down for me.
Imagine you are building a physical filing cabinet. The original software engineers back in California designed the drawers to hold manila folders with a maximum label length of, say, 10 characters.
Because their global system uses those short CRM IDs we just talked about.
Exactly. But now we are deploying to Poland, and the accounting policy demands deep analytical linking. We need soldiers labeled 2102-00001 region of product B.
Oh, boy.
Right. You are taking a 30-character text string and trying to jam it into a 10-character drawer.
It's not going to fit.
It won't.
Mm.
When database administrators use tools like FlameRobin to expand the accounts table, say in Firebird or similar SQL databases, to accommodate these deep Polish sub-accounts, they often forget to alter the data type length limits across all the associated tables. So when the ERP tries to write that massive Polish analytical string into the database, the system throws SQL error NAGA 303.
It's a string truncation error. The database literally just snaps the drawer off its hinges and crashes.
Precisely. The transaction completely fails. The roadmap explicitly advises that field lengths for account IDs must be expanded to at least 128 characters globally across the schema.
128 characters?
Yes, just to safely handle the depth of Polish analytical requirements. If you treat localization as just a UI translation task and ignore those back-end column widths, your ERP will fail the literal moment a user tries to create their first localized ledger entry.
Wow. So this architecture really dictates how the daily operations run. But, we need to zoom out for a second and look at who actually owns this ledger.
The entity type.
Right. The entity type in Poland drastically changes the configuration of Class 8, which are the equity accounts. And mapping foreign equity structures into Poland requires intense legal translation, not just word translation.
Yeah, equity represents the legal claim the owners have on the business. And that claim is structured entirely by the Polish Commercial Companies Code.
The Codex Spółek Handlowych.
Yes. The roadmap focuses heavily on capital companies because they are the standard for any business large enough to actually require a complex ERP system.
Makes sense. So the most prevalent acronym you see in Polish business is SPZOOO. Spółka z ograniczoną odpowiedzialnością.
It's a mouthful, but yes.
It's the equivalent of an LLC, right? What are the financial parameters an ERP needs to know for that?
Okay, so a SPZO.O requires a minimum share capital of 5,000 PLN. Crucially, the equity is divided into shares, but the exact legal term for these shares is udziary.
Udziary. Okay, and how does that differ from the SA, the Spółka Akcyjna?
The SA is a joint stock company. It's designed for massive enterprises or publicly traded entities. The minimum capital jumps to 100,000 PLN.
Significant difference.
Very. But here's the critical data point for the software. The equity in an SA is divided into stocks or shares, but the legal term is AJ.
Yep, I do.
Never udziary.
Why does a software developer care about the noun used for a share? Does it really matter?
It matters immensely because ERP systems generate automated shareholder statements, equity reports, board documentation.
Right.
If your system is configured for an SA, but the localization file maps the English word shares to udziaki instead of akje, every single legal document generated by the system is fundamentally defective.
Oh, wow.
It would be like a U.S. corporation legally issuing partnership units instead of common stock. It's legally incoherent.
I see what you mean. Now, there is a third entity mentioned in the roadmap, the PSA, the Prosta Spółka Akcyjna. This seems like a newer structure.
It is. It was introduced relatively recently to really spur the tech startup ecosystem. It's a simple joint stock company.
Simple. So what's the barrier to entry?
Radically lowered. The minimum share capital is just 1 PLN.
1 zloty.
1 zloty. And the shares do not have a nominal value. The ERP has to be capable of establishing an entire equity architecture on a foundation of a single zloty.
That's fascinating. Let's talk about mapping foreign equity into this Polish structure, though, because so many ERPs are rolled out by foreign parent companies. Let's say we are taking a South African company using IFRS, right?
Well,
and they are setting up a Polish SPZOO. The South African chart of accounts has ordinary shares and share premium. How do we map that to the Polish Class 8? I assume we can't just run those terms through Google Translate.
No, absolutely not. If you try, the AI will likely hallucinate a literal translation that has absolutely no legal standing in Polish corporate law.
Right.
You have to translate the legal intent. The South African ordinary shares must map to Polish account 801, which is kapita podstawowy.
Kapita spały.
Yes. That tracks the registered baseline capital. And the label must explicitly be udziai given our SPZOO example.
Okay, so what happens to the share premium? You know, the money paid over the nominal value of the share.
That maps to account 803, kapita zapasowy, the supplementary capital account.
Sure.
And the specific technical description required there is Naduka sini emiznini nagwartashu nominalno.
That's quite a phrase.
It is. It means the surplus of the issue price over the nominal value. It's often just referred to as agio.
Agio.
But if your automated mapping tool lacks the context of the Polish commercial company's code, the resulting localized software will look entirely unprofessional and, frankly, very suspicious to an auditor.
So we have the ledger balancing, we have the equity legally defined. Now we arrive at the ultimate friction point of any enterprise software.
Extracting the data to pay the tax authority.
Exactly. And the Polish Ministry of Finance does not want a PDF of your balance sheet. They demand highly structured, deeply integrated digital files.
Yes. The Polish tax authority is actually among the most technologically advanced in Europe.
Really?
Oh, yes. They operate on continuous transaction controls. And the foundation of this is the JPK, the Jednolity Pliktkontrolny.
The standard audit file for tax. The roadmap refers to JPK v7. How does this actually work mechanically between the ERP and the government?
Okay, so it is not a document you can just read. It is a rigid XML schema.
XML.
Every business must extract their sales and purchase registers, map them to specific tax codes, and generate this XML file natively from the ERP.
So the ERP does the heavy lifting.
It has to.
Yeah.
If you are a monthly filer, you generate the JPK v7m. If you file quarterly, it's the JPK v7k.
Okay, but what happens if the ERP's mapping is, slightly off? Say a developer uses the wrong XML tag for a specific type of VAT-exempt service.
The government's Gateway API will instantly reject the file.
Instantly.
Instantly. There is no human reviewer on the other end trying to decipher what you meant. The XML schema validation is entirely binary. If it fails, your company is non-compliant and the penalties accumulate very rapidly.
That is terrifying for an IT director.
Very.
But that XML file just reports the tax, right? How the tax is actually paid involves a mechanism that completely alters accounts payable workflows. The split payment mechanism.
Yes, the MPP mechanism podzielone płatności.
Break that down for me.
It is a mandatory anti-fraud measure. It's designed specifically to prevent VAT carousels.
Okay.
If a business-to-business invoice exceeds 15,000 PLN gross.
15,000 PLN.
Right. And the goods or services fall under specific sensitive categories like electronics or construction materials, the buyer is legally forbidden from paying the full invoice amount directly to the supplier's operating account.
Wait, the buyer dictates how the supplier receives their own money?
Yes.
How does the ERP actually execute a split payment?
It happens at the banking API layer.
Yeah.
When the ERP generates the electronic bank transfer file, usually an MT100 or a .001 XML file, it cannot just send a single instruction for, say, 12,300 PLN.
Okay.
The software must generate a specific split payment message block.
A message block.
Right. It tells the banking system, here's the net amount of 10,000 PLN, send it to the supplier's standard account, and here's the VAT amount of 2,300 PLN, accompanied by the specific invoice number and the supplier's tax ID.
And the bank's routing system physically splits the funds based on that ERP metadata.
Yes. The bank intercepts the 2,300 PLN and forcibly deposits it into a restricted, dedicated VAT account owned by the supplier.
Wait, consider the cash flow implications of that.
They are massive.
If I'm a Polish supplier and 23% of all my high-value B2B revenue is being siphoned off into a restricted account, I can't use that money for payroll. I can't use it for R&D.
You cannot. The funds in that dedicated VAT account are locked in a closed loop.
A closed loop, so what can they use it for?
The supplier can only use that money to pay their own VAT liabilities to the tax authority or to pay the VAT portion of incoming invoices from their own suppliers using the exact same split payment mechanism.
Wow. That severely impacts operational liquidity.
It absolutely does.
And that places an enormous burden on the ERP's document generation engine as well, right?
Immense burden. The ERP must recognize all the parameters B2B, over 15,000 PLN, sensitive category, and it must automatically print the exact phrase, mechanism podzielone płatności, on the outbound sales invoice.
Automatic.
Yes. If your software fails to print that trigger phrase, the invoice is legally defective, and both the issuer and the buyer face severe financial sanctions.
Oh my. Now, the actual calculation of the VAT is a multi-tiered maze, right? We have the standard 23% rate.
Correct.
We have an 8% rate for construction and medical goods, 5% for basic food and books, 0% for exports, and an exempt category marked Zuduja for financial services.
You got it.
But the roadmap highlights that the greatest danger isn't actually the math. It's the terminology used in the user interface to describe the math.
Exactly. The interface is where statutory complexity meets human psychology.
Right.
If an accountant sees bad grammar or literal translation in a tax module, they instantly lose all faith in the system's underlying mathematical integrity.
It just looks broken.
Exactly.
Let's talk about the absolute standard terms, then.
Okay, so netto is mandatory for amounts excluding tax, and brutto is mandatory for amounts including tax. Never, ever use literal translations of the English excl or inkle.
Netto and brutto. Got it. And what about the tax ID? In the U.S., it's an EIN. In the U.K., a UTR.
In Poland, it is the NIP, Numer Identyfikacji Podatkowy. Every UI field capturing a tax reference must be labeled NIP.
NIP. Okay, how do we differentiate the V8 we charge from the V8 we pay? Because that sounds like a potential disaster.
Oh, it is a critical point of failure. Output VAT, the tax you charge your customers, is VAT naliczony.
VAT naliczony.
Right. And input VAT, the tax you pay on purchases that you intend to reclaim, is VAT naliczony.
Naliczony.
If a developer swaps these labels, the tax reports will be entirely inverted. You'll be showing massive liabilities instead of assets, or vice versa.
Which would be catastrophic. I want to look at the danger of Google Translate again. Let's say a developer is rushing to push a localized UI. They take the English phrase debtor balances or open item journal, and they just run it through an AI translator.
Bad idea. If they translate debtor, they will likely get dużynek.
Dużynek. Is that wrong?
In everyday Polish, dużynek implies someone who is in severe debt, perhaps facing debt collection or bankruptcy. It carries a very heavy negative connotation.
Oh.
It definitely does not mean a standard reliable customer with a standard 30-day payment term.
So what is the professional terminology? We keep circling back to this foundational word in Polish accounting.
Rozrachunki.
Rozrachunki.
Yes. To be compliant, you must use rozrachunki's odbiorkami for customer receivables and rozrachunki's orzadem skarbowym for settlements with the tax office.
It's all about that word.
It is. If you use rozrachunki, you are speaking the language of the 1994 Accounting Act. If you use AI-generated synonyms, you're basically speaking nonsense, and the local users will reject the software.
Okay, now the roadmap dives really deep into the grammatical nuances of UI and database localization, and it basically proves that Polish declension is a nightmare for hard-coded software logic.
It really is.
In English, you can write a line of code that just says, print amount plus dollars, and it works for literally everything except exactly $1.
Right, nice and easy.
How does currency grammar work in Polish?
Well, the word zloty translates literally to golden. But because Polish is highly inflected, the ending of the word changes based on the numerical quantity preceding it.
Oh, boy. So how does a developer build a dynamic string for the UI?
With great difficulty if they aren't using advanced localization libraries like the ICU message format.
Give me some examples.
Sure. In Polish, 1 is zloty, but numbers ending in 2, 3, or like 22 or 43 take the nominative plural, which is zloty.
Okay, so it's 22 zloty. What about 5? Or 100?
Numbers ending in 5 through 9 as well as 0. And the teens, like 11 through 19, they take the genitive plural, which is zutich. So 100 is 100 zutich.
So if a developer just concatenates zloty to the end of every database query, 90% of the financial dashboards will feature glaring grammatical errors.
Yes, exactly. The roadmap's pragmatic advice is that for static, overarching labels in the software, such as total assets and PLN, using zutich is the safest professional choice.
Just default to zutich for static labels. What about the currency symbol itself? In the U.S., the $sign goes before the number.
Well, the ISO code PLN is used strictly in international banking modules. But for domestic localized interfaces, the official symbol is a lowercase z.
Lowercase z.
Right. And must be placed after the amount, separated by a non-breaking space.
Oh, a space. Interesting.
And the minor unit, the cents, is the gross, symbolized as a lowercase grust.
And the formatting of the numbers themselves? Are there commas, periods?
Very crucial. The decimal separator must be a comma, never a period.
Comma for decimals.
And the thousand separator is a space.
A space.
So 1,200,000 zloty and 50 gross is written as 1 space 200 space 50 0, comma 50 se.
Okay, so if you push a US formatted number string with periods and commas inverted, you are going to cause massive data entry errors.
Absolutely.
Now, moving from the front-end UI back into the database architecture, the roadmap gives a strict rule regarding the types table. This is the table that stores the names of documents like invoices, orders, quotes.
Yes, the types table.
The rule is absolute. Document names stored in the database must be singular. You must store factura, meaning invoice. You must never store factory, meaning invoices.
Never.
But why does the database care about plurality? If I have a drop-down menu filtering a list of my invoices, shouldn't the UI read invoices?
Because of how ERP reporting engines dynamically pull data.
How so?
When the software generates a PDF of a single invoice to send to a customer, the layout engine queries the types table for the document title, and it prints it in, say, massive 24-point font at the top of the page.
Oh, I see.
If the database stores the plural factory, you will literally hand a customer a single document with the bold heading invoices. It makes the company look completely incompetent.
So pluralize in the front-end code, keep the back-end singular.
Yeah.
Got it. Now, one last thing on translation. Is there anything in an ERP system that we should absolutely refuse to translate into Polish?
Yes. You must fiercely protect technical banking acronyms. IBAN, BIC, SWIFT.
But IBAN stands for International Bank Account Number. Wouldn't a thorough localization effort translate international and account to their Polish equivalents?
If you do that, you will destroy the company's ability to process payments.
Destroy it.
Yes. These acronyms are global infrastructure standards. They operate as proper nouns across the entire global financial ecosystem.
Right.
If you change IBAN to some localized Polish acronym, the API gateway connecting your ERP to the banking network will throw an unrecognized field error and the payment batch will fail. Do not localize global infrastructure.
Wow, okay. We have covered an immense amount of ground today, unpacking the friction between global software design and local statutory law. We started with the unyielding reality of the 1994 Polish Accounting Act, which demands that the ledger, the reports, and the underlying data exist natively in the Polish language, basically forcing multinationals to build multi-language database schemas or face the wrath of certified auditors.
And we navigated the hierarchy of the PAA, KSR, and IFRS, demonstrating that global consolidated reporting does not shield a subsidiary from domestic XML filing requirements.
Right. We took a hard look at the Wizarkawi plan cont, and specifically the genius of the Class 4 versus Class 5 expense logic. We saw how Account 490 acts as the ultimate contra-account fulcrum, balancing the objective nature of an expense against its internal managerial function without destroying the P&L.
We explored the bare metal database risks, too, like SQL error NANIC 303, proving that analytical subaccounts require deep 128-character column widths to support the legal demands of the Polityka Rachunkobochi. And we mapped the rigid legal terminology of equity, differentiating between the Ludziari of a SPGOO and the ACHI of a joint stock company.
And finally, we dissected the operational impact of the split payment mechanism locking up operational cash flow and the grammatical minefields of Polish declension zutich. Getting this right is not merely a task for a UI translation team. It requires structural, architectural alignment with the statutory and academic culture of Polish accounting.
It really is the defining line between an ERP rollout that empowers a local workforce and one that is actively resisted, resulting in catastrophic audit failures.
I want to leave you, the listener, with a final thought on the horizon of this technology. We spend all this time discussing the rigid manual engineering required to map global ERPs to Polish statutory law. But today, enterprise software is rapidly integrating large language models and AI to automap cross-border transactions in real time.
Which is a whole different ballgame.
It is. What happens when an AI, optimized for conversational fluency, slightly misinterprets the strict, legally mandated nuances of the Polish commercial company's code? Will the corporate tax audits of the next decade be fought not over missing funds, but over the grammatical declension of a ledger entry chosen autonomously by a machine learning algorithm?
The tension between the probabilistic nature of AI and the deterministic precision of statutory law is definitely the next great frontier in financial architecture.
Something to mull over until our next deep dive.